This is chapter 5's homework. And I am at home, so if you hear the dogs barking, they're my children here at home. I'm going to try to do this in one video. If it gets to be more than 20 minutes, I will do a second video. So just keep that in mind. All right, at the beginning of the year, Myrna Corporation has, Corporation has E&P of $32,000 as earnings and profits. The corporation generates no additional E&P during the year. On December 31st, the corporation distributes $50,000 to its sole shareholder, Abby, whose stock basis is $10,000. How is the distribution treated for tax purposes? All right, so this is number 1. All right, so here's the deal. Generally, when you make a distribution that's less than your earnings and profits, then it's non-taxable. But they have earnings and profits of $32,000 and they distributed $50,000. So some of it's going to be, well, I shouldn't say it's not taxable. It's like a regular dividend that's being distributed. Non-taxable is the wrong word. It's like a regular dividend. But if you distribute more than earnings and profits, then it becomes like a return of capital and or a capital gain, depending on how much you distribute. All right, so they start off with $32,000 of earnings and profits. All right, and they distribute $50,000 to Abby. Okay, so $32,000 is dividend income. This is supposed to be as a result of distribution, Abby. So we're looking at from Abby's viewpoint. So $32,000 is dividend income. All right, that's limited to the E&P. Right. Then a return of capital is our $10,000 basis. Basis in the stock. All right, so that gives us up to, that's 32 plus 10 is 42. We need another 8,000. So the remaining 8,000 is capital gain. Capital gain because her basis has been reduced to 0. All right, she had a basis of 10, and when you had that return of capital, that reduced it to 10. So 0 is her basis, stock basis after distribution. 10 was her basis minus the 10 return of capital. All right, number 2. Oh, let me put all this in here. All right, on January 1st of the current year, Rondell Corporation has accumulated earnings and profits of $13,000. Current earning and profit for the year is $84,000 earned even throughout the year. Elizabeth and Jonathan are sole equal shareholders of Rondell from January 1st to April 30th. On May 1st, Elizabeth sells all of her stock to Marshall. Rondell makes 2 distributions to shareholders during the year: a $42,000 distribution, 21 each to Elizabeth and Jonathan on April the 30th, and then a total of $58,000, 29 to Jonathan and 29 to Marshall on December 31st. Determine the allocation of the distributions by completing the table below. Assume the shareholders have sufficient basis in their stock for any amount that is treated as return on capital. Okay, so you're just supposed to say, what is the distribution? Is it from current E&P, from accumulated, and then is it treated? Okay, so they have current E&P of $84,000. All right, their distribution during the year are the 42 and 58. All right, so what happens is distributions are treated generally as coming from current E&P, but since the distribution is more than current E&P, then you have to like split it between the accumulated and current. All right, so since the distribution is more than current E&P, they must be split between current and accumulated. Okay, so for each one, we have to determine what comes from where and if any of it's treated as return on capital. All right, so for the April 30th distribution, what you do is take the current E&P of 84,000, all right, then times the 42,000 was the first distribution, and then that is divided by the total of the distributions. So it's kind of like a prorated share. So 42,000 plus 58,000. See if I put that formula in there correctly. All right, so 35,280 will come out of current E&P. All right, the rest of that one will come out of remainder from accumulated. Okay, so they had 42,000 was the current distribution minus 35,280. That comes out of accumulated. All right, we don't have any return on capital. All right, then you do the same basic thing for December 31st. All right, it's going to equal the 84,000 times the 58 divided by, I'm cutting out the zeros, okay, the 42 plus the 58. Divided by 42 plus 58. All right, that's from current E&P. Leaves from accumulated E&P 58,000 minus 48,720. Okay, but, all right, so it would be 9280 from accumulated EMP, but there isn't that much in accumulated EMP. All right, so they started with 13,000 accumulated EMP. Beginning accumulated EMP had 13,000. All right, from the first distribution, so from the April distribution, they took out 6720. So that leaves 6280. All right. So the most I can take out is 6280. All right. That is from there. Oh, excuse me. That is not what I want. All right, never mind. Okay, so now I'm up to December amount allocated. We had 48,720. Oh, excuse me. From current EMP. 6280 from accumulated EMP. Here's what it was, 58,000 total. So I've allocated 48. I've allocated the 6. All right, so it's remainder of 3. That is a return of capital. Because there's no more EMP for it to come out of. So 48,720, 6280, oops, and 3,000. All right, that's number 2. All right, number 3. Rover Corp would like to transfer excess cash to its sole shareholder, Alicia, who is also an employee. Alicia is in the 24% tax bracket, and Rover is subject to a 21% rate. Because Alicia's contribution to the business is substantial, Rover believes the $25,000 bonus in the current year is a reasonable compensation and should be deductible by the Corp. However, Rover is considering paying Alicia a $25,000 dividend because the tax rate on dividends is lower than the tax rate on compensation. Regarding taxes, which one benefits Alicia the most? Okay. If a dividend is paid, it is taxable to Alicia. At 15%, I think, is the max tax rate. Yes. So it would be 25,000 times the 15%. right, so that's her tax. So the net of tax would be the $25,000 minus $37,550. So she's gonna put $21,250. All right, if bonus paid, it's taxable at 24%. Know what they said? Times 124. So the net would equal 25,000 minus 6,000. 19,000. Okay, so the $25,000 dividend would benefit her because after taxes she would have $21,250 from the dividend and only $19,000 from the bonus. All right, regarding taxes, which would benefit Rover Corporation the most? The $25,000 bonus because it's tax deductible. And let's see, bonus would save Rover 25,000 times 0.21. 21, that's not right. Oh, let's only put 10%. That's still not right. Because I put 21,000 and not 25. I'm crazy. I'm so sorry. There we go. It would save Rover $52.50 in taxes. Because if they pay a $25,000 dividend, that is not deductible. All right, so make note of that. Dividend is not tax deductible to Rover. All right, considering the two parties together, which alternative would provide the most overall savings? The $25,000 bonus okay, let's see. Savings between this minus this. Oh, that's not what I wanted to do there. All right. Actually, the bonus cost of bonus to Alicia. All right, but it saves Rover $52.50. So it saves Rover $52.50. Cost Alicia $22.50. So overall savings of $3,000 if they pay the bonus. And since she's a sole shareholder, she's going to pick what's cheapest overall. So they would pick that. So it'd be a net tax savings of $3,000. Let's check that because I don't know. Yes, okay. On to number 4. And I've already used 10 minutes. I'm assuming that's 10 minutes and not 19. Global Corporation distributed property with an $850,000 fair market value and a $415,000 adjusted basis to one of its shareholders. The property was subject to a $230,000 mortgage, which the shareholders assumed. Global has ample earnings and profits to cover any distributions made during the year. What is the amount of the shareholders' dividend income on the distribution? All right, number 4. We got property with a fair market value All right, basically, the dividend on a property distribution equals the fair market value of the property. All right, so the fair market value of property was $850 that he received, but it came with a $230,000 liability assumed. So you can knock that off. So that is the dividend. Shareholders' basis and the property received is the fair market value on date of transfer. So $850,000. That wasn't so bad. Number 5. Quinlan has ample earnings and profits to cover any distributions made during the year. One distribution made to a shareholder consists of property with an adjusted basis of $150,000 and a fair market value of $90,000. What are the tax consequences of this distribution to Quinlan? Quinlan is the corporation. Okay, so Quinlan is the corp. Nice to keep that straight in your head. So basically they have a fair market value of 90, a basis of 150. If you subtract those two, this is a realized loss. All right, but they don't get to deduct the loss. All right, so they have a realized loss of 60, of which 0 is recognized. And then the basis carries, the fair market value carries over. All right, not deductible. Shareholder receives property with the basis equal to fair market value of property. All right, next one, number 6. Fargo Corp distributes property with the basis of $260 and a fair market value of $310 to a shareholder. Fargo Corp has sufficient E&P for its distributions. What are the tax consequences of this distribution to Fargo? And once again, Fargo is the corporation. Fargo Corporation recognizes a gain, I'm thinking right, 310 minus 260, a gain of $50,000. The net increase, decrease. Oh, because you're giving away property of 260. So you're taking 260. The dividend that comes out is 260, which is their basis. And the shareholder has dividend income of 310 is what I'm going to say, which is the fair market value. Let's see if I'm right. Yes, okay. So they have a gain, and it's the 310 fair market value minus the $260,000 basis. All right, accumulated earnings and profits decreases. because you paid a dividend, and it decreases by the basis of property given. All right, shareholder has dividend income equal to fair market value of property received. All right, and this is because they can turn around and sell it for that amount and get the cash if they want. All right, number 7. Dero Corp lends its principal shareholder Lafayette $500,000 on July 1st of the current year. The loan is interest-free and payable on demand. On December 31st, the imputed interest rules are applied. Assume that the federal rate is 3% compounded semi-annually, so every 6 months. What are the tax consequences of the loan? All right, so Lafayette is the shareholder. So Lafayette has dividend income. Deerwood has interest income, the corporation. Because you're going to act like he's actually paying interest even though he's not. And that interest that he's not having to pay is considered dividend income to him. And the amount is going to be the $500,000 note times the 3% interest times 6 out of 12 because it was July 1st. So it's a constructive dividend is what that's called. $7,500, and they have interest income of $7,500. All right, so Lafayette doesn't actually pay the dividend, the interest, I'm sorry. It is considered a constructive dividend. All right, number 8. What are the tax consequences to Euclid from the following independent events? All right, this is a person. Euclid is like a person, basically. Euclid bought 500 shares of common stock 5 years ago for $50,000. This year, E receives 20 shares of common stock as a non-taxable stock dividend. As a result of the stock dividend, Euclid's per share basis is what? Okay, well, they had 500 shares. They now have 520 shares. They originally paid $50,000. For it. So just divide the two. And that's the basis per share. So what is $1? All right, so that's A. Assume instead that Euclid received a non-taxable preferred stock dividend of 20 shares. The preferred stock has a fair market value of 5, and the common stock on which the preferred is distributed has a fair market value of $75,000. After we receive the stock dividend, the basis of the preferred stock is blank, and the basis of the common stock is blank. Okay, so you basically have to split the $50,000 basis that she already has between the two. And it's split, she's got 5,000 preferred stock market value plus $75,000 common stock market value equals a total market value of $80,000. All right, so the preferred stock will get, all right, it has 5,000 over 80 times the $50,000 basis, original basis. So 5 divided by 80 times 50. And then the common stock gets what's left. So a total of 50,000 minus the 3125. $46,875. Let me go put on my dollar signs again for a little while. So 3125 and 46,875. All right, a corporation with common stock outstanding declares a non-taxable dividend payable in rights to subscribe to common stock on June 30th of the current year. Each right entitles the holder to purchase one share of stock for $25. One right is issued for every share of stock owned. Thomas owns 100 shares of stock purchased 10 years ago for $1,000. At the time of the distribution of the rights, the market value of the common stock is $40 per share, and the market value of the rights is $5 per share. Thomas receives 100 rights. On September 30th, he exercises 75 of the rights and sells the remaining 25 rights for $6 per right. Assume that Thomas does not allocate his original stock basis to the rights. What is the basis in his new stock? Number 9A. All right, basis in new stock, since he doesn't allocate anything, is just, I think, going to be what he paid for it, probably, right? He got 75 rights. Okay, sorry about that. And on top of that, I'm at 33 minutes apparently, but I'm just going to keep on going. It'll be like class time. All right, so assuming that Thomas does not allocate his original stock basis to the rights, what is this basis in the new stock? Okay, it is going to be 75 times the exercise price of $25. So 1875. When does this holding period begin for the new stock? The holding period for the new stock begins when it's purchased. What are the tax consequences of the sale of the rights? All right. On September 30th, he exercised 75 and he sells the remaining 25 rights for $6. The seller right produces, okay, it actually produces a long-term capital gain because it was paid on stock that he bought 10 years ago. And it's the 25 rights times the $6. So $150 gain. Thank you. All right, number 10. Oh, excuse me. Okay, this one deals with trying to calculate EMP. All right, Sparrow Corporation had the following transactions in 2020, its second year of operations. I'm going to have to make this a little bigger. How do I make it bigger? Why isn't it working? There we go. Okay. So we have some things up here. Sparrow uses the LIFO inventory method, and its LIFO recapture amount increased by $10,000 during 2020. In addition, Sparrow sold property on installment during 2019. The property was sold for $40,000. It had a justice basis at sale of $32,000. So that's an $8,000 overall gain. During 2020, Sparrow received a $15,000 payment on the installment sale. Finally, assume that no additional depreciation, first-year depreciation, was claimed. All right, and we have to indicate whether each item or part of the item is added to, deducted from taxable income, or is no effect when computing current E&P. All right, so this is kind of like one of those things like, what's the difference between taxable and non-taxable? And some things go into E&P but don't affect tax, and that's what we're having to do. Okay, so I guess I'll make this a little bit smaller. All right, federal income tax paid. That is deducted. All right, we get to deduct that for E&P, or we have to deduct it for E&P because we had to pay it out. Okay, let's think back to our E&P. Dividends come out of earnings and profits, so you're trying to figure out how much money there is in there for earnings and profits. So we did not get to deduct our federal taxes when calculating taxable income, but we subtract it out to get to E&P. All right, tax-exempt interest income we did not include in taxable income, but we want to add it back because it is money that we have. All right, so tax-exempt income, add. All right, it's an increase in, I'm going to say economic income. That's what the book calls it, because we actually had that money to pay dividends from. Non-deductible meals. All right, we didn't get to deduct it for tax purposes, but we did spend that money, so we have to deduct the rest of it. We don't have that money anymore. Life insurance premiums are non-taxable. But we do have the money, so we're going to add it back. Oh, wait. What does this say? A Sparrow and its life insurance premiums paid. Sorry. They're non-deductible. I was thinking it was actually life insurance they collected. Non-taxable deduction. So we didn't get to deduct it for tax purposes, but we don't have that cash anymore. So we have to deduct it. Don't have that cash. Sorry, I misread that. Here's the one I'm thinking. Proceeds from a life insurance policy. That's where we actually got money. All right, that's non-taxable income, so we can add it back. I put this life insurance premiums. All right, excess of capital losses over capital gains. Oh my gosh. All right, we don't get to deduct those losses, but we did have them, so we need to subtract them on out. excess modified accelerated cost recovery. All right, this means that our tax deduction was higher than our book deduction, so we get to add that back. All right, Section 179 expense elected in 2019. All right, Section 179 says that we can subtract, that we can deduct like the cost of equipment and things in full instead of depreciating it out. All right, we have to deduct this to get to E&P, and here's why. For E&P, expense must be deducted over 5 years. So in 2019, 80% was added back because they only got to deduct 20%. So 80% was added back. And then the remaining 4 years, %20 of it is deducted. All right, dividends received deduction. All right, so dividends received deduction means that, we got this dividend money from corporations, and then we got to subtract some of it out to get taxable income, but we can add that back because we actually did get that money, and it's there for the payment of dividends. The money is. All right, a LIFO adjustment. All right, let's see what this one is. LIFO recapture amount increased by $10,000 during the year. So we're going to add it. Increases in LIFO recapture are added, decreases are subtracted. I've been doing this. Deducted. Dividends received is added back. The LIFO is added. And the installment sale. All right, installment sale, that amount is deducted. Not permitted for E&P. Oh, and then I didn't do them all up here. They're up here. Dagnabbit. So I'm going to have 330. All right, I'm just going to type them out. So we said federal income tax is deducted, minus 69,300. The tax exempt income is added. I just subtract out the disallowed meals. The life insurance difference we have to subtract out. The premiums. The proceeds we have to add back in. Excess capital losses were 13,000. Depreciation was 10 to add back. Section 179 is 5 to subtract out. Which is 20% of 25,000. $25,000 times 0.2. The LIFO recapture we're going to add back. And then the installment sale gain. The installment sale gain is $15,000 payment on the installment sale. So it's the $40 what they sold it for minus the 32 basis. That was the $8,000 gain. Divided by the 40, that you're finding the gross profit rate. And then that is times the money received of $15,000. And it's not going to work. Oh, it's okay. I didn't have to work because I don't have the formula anyway. So 8 divided by 40 times 15. 3,000? Okay, then add those up. I have something wrong. So 330, 69.3. This is 5,000. This is 1,500. 2,800, 110, 13,010, 5,000. I left out the dividends received deduction. Where should it go? It should go above this. So let me move these down too. Dividends received deduction was 17,500. All right, and that was still not right. That is the 35,000 times 50%, because that's the dividends received deduction. Oh, this is supposed to be minus 3,000. There. $387,900. Let's see if that's right. I don't know. Yes, okay. Number 11. Okay, I'm sorry this video is so long, but anyway, I'm going to keep going with it. Number 11 is kind of the same thing. In each of the following independent situations, except they're independent situations, so we don't have to calculate taxable income in the end. Or E&P, sorry. In each of the following independent situations, indicate the effect on taxable income in E&P, stating the amount of any increase or decrease in each as a result of the transaction. Assume E&P has already been increased by taxable income. Enter a decrease as a negative number by using the minus sign. If there is no effect, enter 0. Okay, realized gain of $80,000 on involuntary conversion of the building. 10,000 of the gain is recognized. All right, so basically what that means is they didn't like sell it or anything. They, there's a fire or the government took it or, something like that. All right, so taxable income increased by that 10,000 of recognized. E&P was no effect. All right, mining exploration costs incurred on May 1st of the current year. $24,000 is deductible from current year taxable income. Guys, calm down. Okay, so it basically tells us that $24,000 is deductible from taxable income. So we have that one. However, for book purposes, so this is part B. Mining exploration cost are amortized over 120 months for EMP computation. All right, so that basically equals 24,000 divided by the 120 months. $200 a month. This was done on May, so May, June, July, August, September, October, November, December. So 8 months have gone by. So $1,600 is deductible for EMP. So that means we need to add back 24,000 minus 1,600. 22,400. All right, sell of equipment to an unrelated third party for $240,000. Basis is $120,000. No election out of installment method. So the corporation will use the installment method. No payments are received in the current year. So on a tax basis, they're not recognizing anything because they didn't get any payments. But for EMP, they're going to recognize the 120. All right, dividends of $20,000 received from a 5% owned corporation, together with dividends received deduction. Assume that taxable income limit does not apply. So less than 15% is a 50%. So that's $10,000. All right, so 20,000. They got 20,000. They get to have a dividend deduction of 10, so the net is 10. And EMP goes up by that same amount. I would think that would be 20, but I don't know. Additional first year bonus depreciation of $45,000 claimed in current year. All right, so for taxable income, it's going to go down by $45,000. Oh, back to this 10. All right, we're just adding back the 10 because they subtracted 10. So their net increase in taxable income was 10, and then we're just going to add back the 10 for the dividend received deduction. All right, so they're getting, on this one, additional first year bonus, they're going to get the minus $45,000 for the depreciation bonus. And then we're going to add that back to EMP. Section 179 expense deduction of $25,000 in the current year. So for taxable, we're taking $25,000, but we only get to take 20% of that for E&P, so we have to add back 80% of it. Impact of current year's Section 179 expense deduction in succeeding years. All right, it's going to have no impact on taxable, but then we get to take a deduction of 20% of it each year. So 25,000 times 0.2 is 5,000. It's a deduction. Modified accelerated cost recovery system depreciation is 80,000. ADS depreciation would have been 90,000. So ADS's straight line is allowed for earnings and profits. So that was 90. So you get to take the 10,000 excess. So this one is minus 80 for tax. And then you get the additional 10 comes off for earnings and profits. Federal income taxes of 80 paid in the current year. You can't take those for tax purposes, but you do subtract it out for earnings and profits. Oh my gosh, let's check that. I'm going to be surprised. Oh, okay. All right, next one, number 12. I think there's 15. I'm not positive. Apricot Corporation distributes property, $125,000 basis and $150,000 fair market value to its sole shareholder, Ellie. The property is subject to a liability of $200,000, which Ellie assumes. Apricot has E&P of $325,000 prior to the distribution. What gain or loss does Apricot, the corporation, recognize on the distribution? What is Apricot's accumulated E&P at the start of the following year? Okay, so property had $125,000 basis they gave out, and the liability assumed was $200,000. So basically, okay, this is going to look funny, but this is a gain, all right, because the liability assumed is more than the basis. So they have a gain of 75,000. All right, and you use liability. Normally you would do the fair market value minus the basis, but since the liability assumed is greater than fair market value, you use the liability assumed. Their new E&P after the distribution of their E&P was 325 plus the gain. So their new E&P is 400. What is the amount of Ellie's dividend income on the distribution? What is her basis and the property received? All right, Ellie has dividend income of 0 because, how do you spell Ellie? The property had a fair market value of, what was it? I don't know, 150? That's her liability assumed. So no income. And then her basis, the fair market value transfers over. That actually is wrong. The answer is $200,000. Oh, because it's the deemed fair market value of the property, which is the liability. At the beginning of the current year, Penguin Corp has accumulated E&P of $55,000. During the year, Penguin incurs a $36,000 loss from operations that accrues ratably. So that means evenly throughout the year. On October the 1st, Penguin distributes $40,000 in cash to Holly, its sole shareholder. Assume Holly has sufficient stock basis for the distribution. How is Holly taxed on the distribution? Of the $40,000 distribution, blank is taxed as a dividend and blank represents a return of capital. Okay, so she got it on October the 1st. So we have to figure out how much income there was at that point. So I got 36,000. Oh, it's a loss. I'm sorry. And it had been 9 months. So that's loss as of October 1st. All right, and then they had 55,000 accumulated E&P. Oh my gosh. All right, so that's the E&P at accumulated E&P at October 1st. So they had a $40,000 dividend. Well, it was a cash distribution. Let's know how it's accounted for. All right, so the $28,000 would be a dividend, and then the remaining 12 would be a return of capital. Almost done, guys. Number 14. Iris Corporation owns 30% of Phreesia Corporation stock. On November 15th, Phreesia Corp, with current E&P of $320,000, distributed land with a fair market value of $100,000 and a basis of $160,000 to Iris. The land is subject to a liability of $80,000, which Iris assumes. How is Iris taxed on the distribution? Iris has dividend income of $20,000. So Iris, she got land. That's the fair market value. But it had a liability. Liability assumed of $80,000. So this is her dividend. It's not her, it's a corporation. Dividend income of $20,000. And she owns it 30%. And if you were to click on the dividends received deduction table, you see that if they own 20% or more, it's a 65% dividend deduction. So 20,000 times 65% is 13,000. And they have a basis in land of 100,000, which is the fair market value. What is Freesia Corporation's EMP after the distribution? Okay, so what you do here, EMP reduction. All right, they started off with 320. That's current EMP. All right, and then we had fair market value of 100,000, 160 is the basis. So since the basis of the land is greater than the fair market value, you use the basis. So the basis of the land was 160, but a liability of 80 was assumed. So the difference, oh, I don't know what I did there. Is 80, and that is the reduction to EMP. So our new EMP is 240. All right, and number 15, last one. Sorry it was such a long video. Can't imagine how long it's going to take for this to post. All right, Parrot Corp is a closely held company with accumulated EMP of $300,000 and current EMP of $350,000. So they have a total of $650,000 in EMP. Tom and Jerry are brothers. Each owns a 50% share in Parrot, and they manage responsibilities equally. What are the tax consequences of each of the following independent transactions involving Parrot, Tom, and Jerry? Independent transactions. How does each transaction affect Parrot's EMP? Parrot sells an office building with an adjusted basis of $350,000 and a fair market value of $300,000 to Tom for $275,000. Now, part of the thing you need to remember on here is that since everybody is related, the numbers are done a little bit differently. Okay, so Parrot has a $50,000 realized gain. I'm sorry. Right here. I read these backwards. It's a loss. Okay, so here's Parrot. You've got a fair market value of $300,000. Notice I'm using the fair market value and not what they actually sold it for. All right, so here's the base at $350,000. So if you subtract that, that's a realized loss. Okay, so $50,000 realized loss, of which 0 is recognized. All right, because I sold it to a related party. In addition, there is a $25,000 constructive dividend. All right, the constructive dividend Tom paid $275,000 for the property with a basis of, or with a fair market value of 300. So property purchased, property sold, however you want to look at it. So take the difference between those two. All right, he got it for $25,000 cheaper. So that's a constructive dividend. All right, as a result, EMP is reduced by the realized loss and the dividend. So EMP is reduced by $75,000. All right, Parrot lends Jerry $250,000 on March 31st of this year. The loan is evidenced by a note and is payable on demand. No interest is charged on the loan. Federal interest rate is 3%. Use months, blah, blah, blah. Okay, Parrot has, they're going to assume they get interest income and is deemed to have paid a dividend too? Yep. Jerry in the amount of whatever. Okay. And I'm guessing these two are going to offset each other, so it's going to be no change. But then we have to figure out how much the implied interest is. Or imputed is what they call it. And it is the note of 250 times the 3% times 9/12. So 56.25. All right. Parrot owns an airplane that it leases to others for a specified rental rate. Tom and Jerry also use the airplane for personal use and pay no rent. During the year, Tom used the airplane for 120 hours and Jerry used it for 160. The rental value of the airplane is $350 an hour and its maintenance cost average $80 per hour. Okay. Tom has a constructive dividend and you just multiply it out. It's the 120 hours times the 350 of 42,000. Jerry has a constructive dividend of 160 hours times the 350. As a result, EMP is reduced by those two added together. Right, Tom leases equipment to Parrot for $20,000 per year. The same equipment can be leased from another company for $9,000. So he's making an extra $11,000 off of it, and that is a constructive dividend of 11. As a result, EMP is reduced by 11. I think that's it. That's it. Let's check the work. Okay, cool. All right, so I'm sorry that took so long. Be looking for the test to be posted. Text me if you have any questions.